panel to preview this week's FOMC meeting. Joining us, Chuck Lieberman, the co-founder and chief investment officer at Advisors Capital Management, and Bill Lee, the chief economist at Milken Institute. Thank you both for being with us. Chuck, we'll start with you. What are your expectations for the Fed meeting this week?
Well, I'm going to be with the overwhelming majority expecting a 25 basis point rate cut. The Fed statement is likely to be kind of neutral. They certainly seem to be leaning towards another cut this year, but I think that's also going to be data dependent.
And Bill, same question to you.
I think the Fed is actually way behind the curve in its rate cutting. The weak housing market and the fact that the labor market is so weakening so rapidly shows they should have done more before, and they need to do more now. And I think I disagree with Chuck in that they're not going to be so data dependent, because I think the trends are pretty in place. The inflation is stabilizing at about where it is now, and fear from tariff-related inflation is overhyped. But the weakening labor market is something that's very serious, especially in face of the trade uncertainty that we're facing.
So, Bill, staying with you here, if the Fed is moving too slowly and potentially doing some real damage to the labor market here, what would a policy mistake look like going forward?
It's going to look like a very weak labor market where new grads are having a hard time finding jobs. There are no layoffs yet because people are still hoarding labor, but the people who are entering the labor market are the ones that are going to be the hardest hit right now. And at the same time, there's going to be a lot of job displacement from a lot of the tech productivity improvements that we're seeing, and we might actually see outsourcing of labor to other places in the world, call centers and other such like things in the service sector.
And Chuck, coming over to you, I'd love to get a response to that, since you both are sort of in different camps, agreement on the cut, but different camps on where we are in terms of the macro picture.
Yeah, that's right. Certainly job growth is slowing, but the question is how much of that is due to lack of demand and how much of it is due to the slowdown in supply. For about 3 years, we had over 3 million people cross the border. About 2 million of those per year were people looking for work. And of course, that door has been slammed shut. So the labor force is growing a lot more slowly. So it's not even possible for the economy to grow as quickly as it did before and hire all those people. They aren't out there. And we see that in the form of the unemployment rate staying very low. My concern is that if the economy gets goosed by lower rates, that we could stimulate the growth or stimulate demand, and supply won't be able to keep up, which will keep inflation higher, not lower. And it's already well above the Fed's target. The target's 2%, and it's actually running around 3%.
So, Chuck, staying with you then, how does the Fed balance those competing priorities, projecting jobs versus protecting its credibility in terms of inflation?
Yeah, that's the difficult needle to thread. They're having a tough time doing it. They acknowledge that. On the one hand, the inflation numbers do not justify any reduction in rates. On the other, growth has slowed. And so that provides some concern, which Bill expressed very clearly. So they're trying to find that balance. And so far, they seem to be doing it in the direction of leaning towards lower rates to reflect concern about the job market. But that may be inappropriate.
So, Bill, coming back to you, as Chuck's highlighting these inflation impacts and inflation concerns, we've seen inflation largely coming from services and the data that we do have. Rate policy can't easily fix that. Does that argue for a more flexible approach from the Fed right now?
The Fed itself is advocating a more flexible approach. It's saying we're going to have a larger array of indicators to show us where the weakness is in the labor market. When I was at the Fed, and certainly during Chuck's heyday, when he was the Fed watcher preeminent out there, everyone focused on the unemployment rate. But now the unemployment rate is a much less reliable indicator for the tightness in the labor market, especially in certain segments of the market that are so important for the U.S. Economy, which is the working class, middle class area where skilled labor is being displaced, low-skilled labor is being displaced by a lot of productivity enhancements from technology. And that is a trend that is making this assessment of the labor market much more complicated.
And Chuck, coming back to you, as Bill fears, if we're really behind the curve here, or we've stayed restrictive for too long, could this strong earnings story that we're seeing start to unravel?
Well, the very fact that the earnings story is so strong is testimony to the fact that the economy is actually doing quite well. That's what the companies are saying themselves. There was a lot of fear expressed over a number of bankruptcies, but they were really one-off situations. And then the banks reported that their performance was actually improving. They're seeing fewer companies in trouble. The quality of earnings is very, very high. So I think that this is a fear that's out there. Bill expressed it well. We know the Fed shares at least some of that view. My worry is that the Fed is being pressured by the administration and they're being a little political. And so they're ceding some ground to lower rates, but it's really potentially not even warranted.
And Bill, last question to you, and we only have about a minute left in the show. Chuck just mentioned some of the fear that we saw in terms of this credit story from the banks, also this tariff concerns that we're seeing about prices. Do you see a potential that we could start to see this drag on growth?
In fact, there's very little sign of drag on growth. The latest Atlanta Fed numbers for estimates for where GDP is, were high threes and possibly even a four handle coming up. So GDP is doing quite well, and again, partly because of productivity. And as far as the markets are concerned, the earnings reports are still very strong, and there's really no evidence of an ebbing of earnings because of the huge productivity gains that we're starting to see realized from the investments in the tech sector and overall investment in general. So for markets our investor audience is concerned, I think they really have to decide where to best place their investment bets, not so much a fear of an overall macro drag from GDP. But the labor market is the hidden source of weakness, and the income generated by jobs is where we're going to have to make sure stays in place rather than losing out even more so.
Well, we have the FOMC meeting starting tomorrow, rate cut decision on Wednesday. Thank you both, Chuck Lieberman from Advisors Capital Management and Bill Lee from the Milken Institute.